Today, Governor Lowe and the Reserve Board met and they changed the cash rate for the second consecutive month, dropping the cash rate down by another 25 basis points. Now, that was reasonably well signalled, even though some economists still thought that they may wait until August. Now, what is their agenda? Well, if you look at the minutes and also a couple of speeches made by the senior executives inside the Reserve Bank over the last month or so, it's very clear that they are going after unemployment. They want to move the unemployment rate down into the low fours. Now, why are they doing that? Well, their argument is the spare capacity in the employment market is actually impacting wages growth. Now, if they don't get that wages growth, then they're not going to get economic growth overall, and they're also not going to get any inflationary pressure. So that is the big news story here. They have really set out their agenda to go after unemployment. And so this could mean further rate cuts throughout the course of this year and into the new year until they get that unemployment rate down and that spare capacity in the marketplace moved. And then ultimately we can start to see that wage growth flowing through, which means naturally, like everything, consumer spending, the whole story gets better and better as that rolls out. Now let's go globally firstly, before we get into the domestic economy. The big news story is still the trade tensions between the US and China. So we have seen some reports come out in this past month, one notably from the World Bank, which talked about these trade tensions is going to impact global GDP by 0.3%. Now that is a significant number, so we'd like to see that that gets sorted out as sooner rather than later. We did see some positive tweets coming out from President Trump in regards to his meeting with the President of China, in regards to positive talks that are moving through. So hopefully we'll see some more resolutions in regards to that. And that's really the global story. When we get into the Australian story, we'll start with GDP. So we did see the March quarter numbers come out. So growth for the March quarter of 0.4%, which meant that the annual pace of growth in the economy has dropped from 2.4% now down to 1.8%. Now that's the slowest rate of growth in our economy since 2009. So again, you can see the reason why the Reserve Bank is trying to get stimulus back into the economy. Now this has been weighed down in most respects really by the consumer sector and that sort of housing downturn that's been playing out since late 2017. Then we move on to the unemployment story. The unemployment story looks like this. So we saw unemployment rate in May steady at 5.2%. So we did see, from a positive point of view, 42,300 jobs created, and this is the strongest in the past 12 months. So that's a good news story. The other interesting story here is the participation rate. So coming back to what we were talking earlier about in terms of the spare capacity, we're now starting to see the participation rate at 66%, which is the highest it's ever been in terms of people looking to get employment. So there's positives and negatives with that in terms of that additional introduction of more people looking for work still keeps that spare capacity in the marketplace. So hence there's more work for the RBA to do in regards to that. On a negative point of view, I think the only thing that was negative in the unemployment numbers was the part-time rate was actually 39,800 new jobs created, and the full-time was only 2,400 jobs. But that was the May number, and again we had an election during that month, so that's something to look at. I then want to turn our attentions now over to the retail spending. So we have seen retail spending, which is the April number. So it's again lag data, and I think it's important to note this. April, we had Easter, school holidays, some uncertainty, the start of the federal election campaigning going on. So we saw retail spending negative 0.1 for the month, and that's the second time it's fallen in the last 5 months. Now, if you think about that, that doesn't quite make sense, right? Because ultimately growing population, more people, you don't like to see retail spending in contraction state. So the annual pace has now dropped from 3.5% in March down to 2.8% in April. Over to the private sector credit growth, and we saw some very weak data in May there. Just a 0.2 of 1% increase, bringing the overall increase for the year at 3.6%. Now this is again a very weak number, and it's the weakest it's been for over 6 years. So more work to be done in this area. Across the three sectors too, so where we actually saw weak credit growth in business and in housing and also in personal credit. So that would also be playing on the minds of our regulators and also our politicians in regards to getting the economy moving. We move on now to consumer sentiment in June. So down from 101.3 down to 100.7. And so that was also despite that first rate cut. So I suspect once again the RBA has seen that rate cut and said it's not flowing through just yet. So that's the reason why they pushed for this immediate second rate cut in July. Consumers are really still worried about the overall economy. That's what we saw coming out in regard to that consumer sentiment survey. When it comes to the business sentiment survey, which is May data, so we saw business confidence. Now this was a sharp improvement post-election. So we did see that move from a 0 reading to a +7 post-election, and that's the highest it's been in 10 months. So you can see that business people do want consistency. They want to make sure that there is clarity around the future direction of policy, and we've seen that bounce. Also positive, we saw the unemployment index inside that survey from NAB moving from a -1 to a +2, and then that was also a positive story. On the negative side, the business condition index, which was sitting at 3, has moved down to 0. So the result in April was +3. We're now down to 0. And I think that is also a consequence of people sort of seeing how poor the economy has been operating in the first 3 to 4 months of the new calendar year. So now, that leads me into one of the big observations inside this business survey, and it's something that is correlating into results that we're seeing now, just released yesterday from CoreLogic, and that big bounce was this. So when the question was asked inside that survey, time to buy index, so the time to buy index increased by 1.8% to a reading of 116.9. Now, any reading above 100 is optimistic, any reading below 100 is pessimistic, but here's the big one. House price expectations. So house price expectations increased by 22.7. Okay, so from a reading of 89.7, so pessimistic about house prices back in April, has now bounced incredibly to 109.7. So, and that's house price expectations. So people think the value of their properties will grow. And that is the perfect segue into the CoreLogic data that we've just received yesterday. And that did show for the first time that house prices in Sydney grew by 0.1 of 1%. So they're still down for the quarter. So down for the quarter, -1.1, but positive growth. Melbourne also positive growth for the month. So it grew by 0.2 of 1%. So the quarterly result for Melbourne is -0.6 of 1%. So that means that since July of 2017, which was the peak of the Sydney market, we've now seen our first growth month. In regards to Melbourne, the peak of the Melbourne market was in November of 17. We've now seen our first peak month. Now overall nationally, we're still down -0.2 of 1%. And overall for the quarter, we're down 1%. And overall nationally annualised, we're still down 6.9%, but fundamentally down by our two biggest cities. So when we do the wrap up of the other centres, Brisbane down -0.6, Adelaide down -0.5, Perth down -0.7 for the month, Hobart +0.2, Darwin down -0.9, Canberra down -0.9. So combined capital cities is -0.1, combined regional centres -0.4, giving us our overall national -0.2 story. But this is June. Okay, so 1 month after the federal election, and what we're seeing with rate cuts starting to flow through, We do know that the buyers are on the ground. We do see auction clearance rates improving, so we could see further improvement in July. Now, I anticipated that we would be at flat or positive by August, September. It could be even earlier than that. We could see a positive price growth story as early as July of this year. But one thing's for sure, we are definitely moving in the right direction there. So when we get to that stage, what's going to ultimately happen is people's confidence will return, and hopefully so will their consumer spending. This week also sees the return of the 46th Federal Parliament of Australia, and the big agenda item that we do need to see from an economic point of view is these tax cuts. So we want to see these tax cuts passed as quick as possible through the House of Reps and then through the Senate. That is going to provide further stimulus to the economy and hopefully get retail spending and consumer confidence moving in the right direction. And that will be an interesting story here. Now, I want to finish on a couple of points. Firstly, I want to say what is interesting about the RBA's decision to go aggressively after unemployment and try and lift the real wages in this nation is that from their observations around what APRA did in regards to impacting credit policy and also now effectively giving them a second lever. So I'm now calling this a top-down lever. So now the RBA has confidence that they have a top-down lever in regards to APRA. So APRA will have the ability to control credit, whereas traditionally monetary policy was a bottom-up lever that would allow to bring cash into the economy. So now the RBA can bring cash into the economy, but you can start to see APRA playing a bigger role in controlling property values. So it means that money can be cheaper for business, for personal credit, which in business sense is actually very, very good for the economy because it means growing jobs. But you can actually still see APRA playing a more important role in terms of ensuring that property prices don't get ahead of themselves like they did in 2017. So it's going to be an interesting time. I don't want to see property prices blast off again, nor do the regulators, nor is it good for the economy. What we do want to see is steady, gradual growth over the course of the next couple of years. Finally, what does this mean in terms of this cash rate cut? What are the lenders going to do? So we saw the ANZ and also Westpac getting a lot of negative press and scrutiny in regards to not passing that on. For the very first time, we saw our federal governor, Dr. Philip Lowe, accuse them of not doing the right thing by their customers and to shop around. That's never been done before. So what will ANZ and Westpac do? Will they pass on the full 25? And then what will CBA and NAB do, considering that they did pass on that full 25? And that's that balance of regards to borrowers versus deposit holders in regards to the interest that they earn on their money in the bank. So interesting times ahead. I don't think we're done now that the RBA has laid out a clear agenda in regards to movement on unemployment. So we'll probably see further rate cuts later this year after that tax stimulus rolls through, and then we'll see where wages growth goes, and that will ultimately decide on what the RBA does in the future. Thanks for watching.